He's the Director and Chief Investment Officer at PPFAS Mutual Fund, who's joining us on the show right now. Rajeev, good morning to you.
Good morning.
So looks like we're witnessing a little bit of aversion to risk right now, the kind of moves that we're seeing on the indices. Though foreign money has been coming in the last 2 months, no doubt about that. But what's the mood like? Do you see this setup being a slightly more shaky?
I would think so. So anytime you see weakness in the currency, investors who come from abroad see a dip in their dollar returns. So obviously the market becomes that much less attractive for them. Again, whenever we see rising interest rates, the attractiveness of equities comes down, and higher interest rates, lesser liquidity is a global reality now, increasingly going forward. So again, valuations are not exactly cheap as we speak. So given that all these things are there, it's time to be cautious, and that's what we are seeing probably.
When you say time to be cautious, and does that mean take money off the table, or just wait for us to ride this period over? Because while the global market setup seems to be slightly more negative, we seem to be shielding ourselves pretty okay for now.
So we don't cover all these stocks in the indices, and I don't have a clear view on the index or broader market. When I say time to be cautious, is the factors that could lead to, let's say, lesser corporate earnings or vulnerabilities, as it were. So given that we are going to a tighter liquidity or higher interest rates, leveraged players would be risky at this point in time. Given that overall valuations are stretched, any stock which is looking frothy, one should be cautious in that space. Given that currency is weakening, any company which is vulnerable to, let's say, currency shocks or let's say oil shocks would be risky. So we have seen what happened in airlines, for example. Now again, so far the story has not come out where people who have gone in for ECBs or foreign convertible bonds, they would be under pressure. So one has to be looking at vulnerabilities in the companies that one owns and see if those are looking shaky, and if required, take money off the table. Otherwise, if on a bottom-up basis the prospects are looking good, then one can stay invested.
Interesting. I'll come to that point as well, Rajeev, but define frothy. Is frothy a high-quality space like consumers trading at above average valuations now consistently, or is frothy a mid-sized pocket which might be trading at slightly above average valuations but promise of growth which has not come hitherto, or is frothy the low-quality companies which are hanging on by a bare thread but at any point of time could go off? What is frothy?
Sure. So post January 2018, when we saw a big fall in the broader market, a lot of the low-quality names saw corrections. So I think that risk-off has probably happened. Consumer names, as you pointed out, are looking very, very exuberant, and in pockets maybe closer to froth. Financials is a space where I am increasingly becoming cautious, especially the non-bank lending companies. So these companies are companies which rely on wholesale funding to a large part. They are vulnerable to liquidity squeezes as well as interest rate increases, as well as in the pursuit of volume growth. They have been pushing money out of the door at an increasing pace, and sometimes only down the road you realize that quality is a concern when it comes time to recover the money.
So interesting. Let me dwell on this for a bit. Everybody seems to believe that this time it is different for financials because there is this power of analytics which back the kind of lending that these NBFCs are doing. The lending is happening at a much lower cost because you don't need to open 100 branches for acquiring those 10,000, 1 lakh customers. It can happen via a cell phone, which has happened in a bunch of companies as well. So costs are lower. And while the cost of funds may move up, but the belief is that the RBI will not hike incrementally in such a big way that it will have a massive impact on these companies. You don't agree?
Sure. So I completely take the points that you have mentioned, and that is the reality of the marketplace. CIBIL scores and the likes have come in. Fintech has come about, where you don't have to spend too much in customer acquisition or in the back-end processes and things like that. And that is why this time the problems have not been as severe as we saw earlier in terms of consumer lending, in terms of personal loans or credit cards and things like that. And again, my belief is that many of the small borrowers have intent to repay, which is sometimes higher than those of the corporate borrowers. So they don't have a chance of running away abroad and not repay the banker. The problem that comes about is they may have willingness to repay, but their ability to repay is on the edge. Their past score may be reasonably okay, but any small disruption, and we have seen spike in NPAs, for example. We saw demonetization, or because of demonetization, our NPAs went up. Floods in a state, because of floods, our NPAs went up. GST, or small business owners are facing recovery problems, NPAs went up. So increasingly, as you are financing consumption expenditure, and this is not really professional expenditure like buying a truck or something like that, it's buying a refrigerator or a television set, and as you are lending more and more to essentially the same pocket, and as competition is increasing, my fear is somewhere down the road we may be lowering credit standards, and the pain would come only after a time. So typically the lending book has to be seasoned before we see the real pain. So for example, a couple of people have been seeing stress in the affordable housing related lending, and again the problem is that there are financial institutions and lending institutions which have been there in the business for decades. Some of the newer players who are entering are more aggressive than the established players. Now arguably the newer players have lesser of experience and they should be the more cautious people. So when you turn the things on their head, and where you see loan growth rates of 40–50%, I think there would be something to be worried about. Again, the valuation themselves are not cheap. So even if you argue that loans will not go bad, even then probably there's froth.
You know, just to come back to your previous point, what do you consider as risks right now? Because across the board, macros seem to be improving. We've clocked in 8.2% GDP rate, though the CAD seems to be a little bit of a worry. We've got our inflation somewhat almost under control, approaching the RBI's target. Earnings have seen a boost. You've seen the quarterly earnings picking up. Consumption sector spending has improved. Manufacturing sector as a whole has seen an increment of about 13.5% in the GDP fine print. So individual trigger points are there on the positive side, but do you see a bigger risk looming large above all this?
So one can always look at it glass half full, glass half empty kind of thing. So for each of the points that you made, let's say inflation is more or less under control. You are seeing currency weakening, you are seeing oil prices spike, which results in oil prices increasing, which results in transportation costs going up, wages going up. So inflation may not be that much under control. The earnings growth that we have seen, some are arguing there's an element of base effect given that last year was a GST related thing. So each of the points we can debate either ways. And again, if someone is looking at a medium to long term, these things even out over a period of time. The one factor that I think about a lot is the overall valuation and what price you are paying for either the broader market or the individual companies that one is buying. I think from that point of view, we are not at cheap levels. So given that valuations are a bit stretched, one should be more on the cautious side.
So far in this conversation, we've not come up with anything that you find value in, that you find something that to be attractive from new money point of view.
So given that, let's say, interest rates are moving up, given that currency is weak, we are already seeing, let's say, export-driven sectors doing well. These were high-quality businesses which were under pressure or which did not participate in the rally, given that currency was rock solid for a long time. So you are seeing the IT pack, the pharma pack doing well. Again, a lot of the, especially the IT companies are cash rich, so they are not vulnerable to rising rates. If at all, treasury income will go up as rates go higher. So broadly, hunting ground would be spaces which have not participated so much in the rally, where valuations are reasonably attractive, and on the bottom-up basis, whatever makes sense from a business perspective.
Well, and if we start a conversation about the US markets with Rajeev, it will take another 15-20 minutes. Unfortunately, no time for that. But Rajeev, such a pleasure having you today, giving us your thoughts. Appreciate your time being with us today.